Hey, David, how's it going?
Hey, good. Thanks, man. How you doing?
Good. We just got done with a really fun episode recorded with Blake and Zac, who we had way back on episode 3, right at the beginning of all this. And it was just great. They're such a great group of guys to talk to. And it just was awesome to have them back on the show and see what they've been doing since it's been over a year since we talked to them.
Yeah, they're an inspiring duo, right? Like their volume, their strategy, but also their willingness to learn and grow along the way. Like they're just a lot of great signs that they will be a very successful investor pair. They already are,
Oh,
right?
yeah.
They're already got a ton of properties. They're doing great things. So very cool to see what they're doing. So we thought someone with their experience and their perspective from having a lot of volume of transactions, like number of houses they purchase in a year and things like that. We thought that'd be a great duo to have back as we face a very different market this year than what we saw way back on episode 3, a little more than a year ago, with low interest rates and strong appreciation a year ago, and now much higher interest rates and kind of questionable trajectory on the market. It's a very different world.
And I think it's funny because everybody's got an opinion on this, right? If you ask every investor, they're all going to have a different idea of where the market's going today, where it's going to be. And what I found interesting about Blake and Zac is that rather than getting fancy and telling us their lofty predictions, they were like, no, we're just sticking to fundamentals. Like we just know what is going to happen. We just make sure the numbers work today. And then whatever happens down the road, just it is what it is. So we'll deal with it then. And I really like that approach.
Yeah, the fundamentals answer, like it almost caught me off guard. I was like, that's so cool. And they also, having this pharmacy thread to them, like they do think through some potential negative
Yep.
scenarios and what that would do. So they're still kind of prudent in how they do that. And it was great to hear that thought process of how they kind of stress test their investments to make sure that they don't get hurt if things go sideways, particularly with like loan types and all kinds of things like that. So rather than just sticking their head in the sand and pretending that everything will be okay, they're taking a conservative approach to make sure that if they buy a specific property, they'll still be okay if things get rough.
Yeah, I'm always impressed at how they look through something and then plan for just these little nuanced things like, oh, well, if we do this, it'll make our life so much easier in 5 years. And I'm like, man, what a good way to think about things that just not a lot of investors do, right? We plan for how do I get to the refinance or how do I get to the point where I sell it? And they look at like, what does this look like in 10 years? And how can I make sure that's going to be better for me in 10 years? And I'm really impressed by that. And they not only take that wisdom and impart it quickly on a podcast, but they pass this down to new investors locally and again just on this episode. So it's always great to talk to them.
Yeah, that balance of sophistication and practicality is
Mm-hmm.
just really cool, and how that comes out throughout the episode. The other one that's in there that I don't want people to miss
Mm-hmm.
is they have this great story about the power of relationships and integrity and following through and what you say you're going to do, and how that has even earned them repeat business with people that they work with. And so I think it's just a cool story to showcase how relationships matter in this world, and how, again, just separate from buying an index fund or something like that, like investing in real estate is much more of it's really a people business,
Mm-hmm.
and they bring that point home very clear.
Yep. Well, hopefully you guys enjoy the episode as much as we enjoy talking to Blake and Zac. And with that, we'll just let you jump right in. Blake, Zac, welcome back to the show, guys.
Hey, yeah, glad to be back.
Yeah.
Appreciate you guys having us back.
Yeah, I was back in episode 3, right when David and I kind of kicked this whole thing off, and knew even less about what we're doing than we do now. But really excited to have you guys on. Just talk
Yeah,
more
you
and
guys
more.
are experts now.
We'll pretend that way. That's good.
Yeah,
So, for those that didn't hear the show, a full year ago now, maybe you can give us a little brief overview of both of you guys, the partnership, and just a little bit about your real estate background or your real estate strategy.
sure. So I'm a pharmacist by trade. I actually bought the pharmacy that I work at in Conway back in April. So graduated in 2013 from UAMS in Arkansas. Community practice my whole time. And about 5 years ago, saw the need for financial independence outside of just your pharmacy income. So we jumped into real estate, met Zac, and we've had a business ever since. So we started in 2018 and now have 36 properties together. So it's been good for us. We can dive in more details, whatever you want to do.
Yeah, it's awesome.
Yeah. And my background, I'm
I'm not a pharmacist. I'm business background, co-owner in a remodeling company with my dad. And my wife and I started in 2013 when we got married. And then 2014 we became landlords, actually. And then so 8 years have gone by and we've been buying. And then, like Blake said, we met in 2018. And we've, I guess, since we met Blake, we've, I don't know, quadrupled or 6x'd what we were doing before. I don't know. No, way more than that.
That's awesome.
I don't know what. I'm the multiplier. I'm not good at math, but we've done a lot more since we've become partners with Blake and Kristen. So definitely been blessed in the partnership.
Very cool.
Very cool. And since we last talked a year ago, I know that the market has changed. There's all kinds of things going on. And I know that particularly right now that's catching a lot of headlines with people talking about, where the market is at, where it's potentially going, what's been going on with interest rates. So all those things, just kind of thinking big picture, how has the last year changed your strategy? If you guys have been in this, 5, 6, 7, 8 years in this business, what are you seeing and how has that changed your strategy in the last year since we last talked?
I can't sit still by nature. I'm a go-getter. So I think we were talking about this, before when you guys sent us the questions and talking on the pod, just going over what we want to say. And I think if you have your principles or if you have your equations, the market doesn't matter at all. So your equations and what you need for cash flow.
Let's say for long-term rental.
For long-term rental. Yeah, for long-term, that doesn't really change anything. So sure, it gets harder, but it maybe has to get a little more intuition, a little more insight into the deal. But for us, I don't think it's changed it at all. This makes it a little more fun to create the deal and make that happen.
Blake's an Energizer bunny. So he never quits. So there was a point, was it last year? I think it was last year when I was running, I had 9 doors that I was actively working on aside from my full-time job because we had just bought a bunch of properties. And yeah, it was a lot. And so at one point last year, I said, I'm about to fire myself from being the guy that does the remodels on our rental property. And so we had to work through a lot of things. And so we finally got to a point because Blake can't stop buying. I mean, literally cannot stop buying houses. I got to the point where his father-in-law actually retired. And we may have had that in the recording last time, but his father-in-law retired and started helping rehab our houses. And so we're not doing 9 houses at a time anymore. We'll do 1 or 2. Right now we have 3, I guess.
Yeah, we have 3
going on. So I'll do 1, and then Mick will do 1, and maybe we'll have 1 that we kind of both are working on. So personally, that's how we've been affected, but that's not really anything to do with the market. So the market we also probably couldn't have bought as many properties.
Yeah.
Because of just how many buyers there are per house. I mean, it's unbelievable. Even off-market properties, if somebody texts you, a wholesaler texts you or whatever, if you don't respond like that, then it's gone. I mean, it's nuts.
Well, I think it's changed it too. So you need to have key relationships in this market. Right. So if you're buying deals on the MLS and you're using those equations, nothing's going to work unless you're putting a lot of cash in. So for me, it's having genuine, good relationships with wholesalers, not like, hey, send me a deal, but like, hey, how's your family? Like, let's check in with you. Let's be friends with you. Like, hey, you can send me 4 houses. I'm going to reject all 4. But when you send me 1, we're going to capitalize on it. Mm-hmm. So, and we've got a relationship with 2 or 3 wholesalers. And I think the last couple that we've bought have been from wholesalers. And it's just those relationships where they'll send them. They're not sending to anybody else till they filter through us. And through that, and then there's another 2 we bought, same sort of deal. There was a guy in town, we called it a marriage of a relationship for a year. It took us a whole year to get 2 houses from him. But because we were upfront people, not rude, not demanding. He was very happy to deal with us. So I think relationship are key in this market right now.
Yeah, and I'll add on to that. One house we got, Locust. The guy brought the deal to us, and we said, hey, we could probably do that or whatever. And then he pulled back, and he was going to try to take it himself. And so, and then later we were kind of not in the place to really buy it. So he posted online, and for all these people. So I mean, I saw the comments. I mean, he had like stack of people that were like, I'll buy it cash, blah, blah, blah. Well, he texted Blake and was like, hey guys, I kind of got in on it a little bit, and I have to close this thing by December 27th, I think is what it was. Yeah. It has to, and this was like December 15th whenever he told us this. And we were like, oh shoot, okay. And so he said, I can't go with any of these other buyers because I don't know them. Mm-hmm. Y'all have closed deals before fast, see what you can do. And we were like, all right, we'll take it. So we actually had a lender that told us, hey, I can probably handle that. So we actually did finance that, but yeah, I mean that's a very, very good lesson of just relationship building. He knew we could close, so he came to us, even though he had all these other cash buyers. Yeah, he still came to us because he trusted us.
That's huge. Yeah,
it didn't make him look like a fool.
Mm-hmm.
Yeah.
No, yeah, the relationship and the track record absolutely matters when you're trying for that kind of repeat business, working with partners, folks like that. Just for those that may not have a good context, what's the difference between buying something off the MLS with a realtor and what's a wholesaler?
So a wholesaler is someone who finds the seller, and he usually has a buyer list. So he finds the seller, has a house, and he says, I'm going to buy it for X dollar. Then he turns around and finds the buyer and says, hey, buyers, I've got this house for $50,000 under contract. I'll give it to you for $60,000, so I'll make the $10,000 spread. That's a wholesaler. And then obviously a realtor that has an MLS, they say, we're going to help you get the highest dollar for your property. So they'll list the property at what they think is fair. The buyers all come. In this market, they offer $100,000 over asking price, and then the house is sold. Mm-hmm. So that's the difference. So right now, but used to, whenever you're buying from a wholesaler, we didn't have as much competition.
Yeah.
Now it seems like even the realtors, actually, that list of people, a lot of those were realtors that were wanting to buy from a wholesaler. Yeah. So it seems like the things changed a little bit.
Yeah.
With one thing that we do want to mention though, and that has definitely changed, right? So you said the market is changing in ways that you kind of anticipated or in ways that you're expecting. But what about interest rates? Like those are obviously going up. How have you guys handled that? Is it just lower cash flow, or just better deals have to be the ones that you close on?
So we're now going to probably start facing that within the next couple months. We actually found a local credit union, and a lot of credit unions will do this, but one here in Conway that's local based, they approved us for a year at a locked interest rate.
Oh, wow.
So last October, we got locked in at X amount of dollars at 4.5%. So we have 4.5% all the way through October up to a certain amount. So it's basically like an improved loan amount that they'll do. Now you can use one deal to do it or 10 deals, but once that goes away, we're going to see 5 to 6%. So I think the whole thing is making sure that you stick to your equation. So if you're going to drop 20% off rent, and make sure that number minus what your rent is, or minus your payment and stuff, equals X amount of dollars, that you don't waver from that. So, and honestly, 5 years from now, say rates go up to 9 or 10%. If you're getting that locked in on a 20-year amortization schedule, your principal is going to be lower when you recapture it or refinance. So your payment will be fine.
It's a great, again, just really highlights how important it is to have a good relationship, right? If you guys hadn't had that relationship, didn't have that ability to lock that in with that lender, it'd be a different story, And like you said, it's still weatherable, right? We can all handle the higher interest rates, but it does change things. And so you guys are lucky you don't have to deal with it yet, but the rest of us do.
It just pushed it down the road.
Exactly. Hey, that's not a bad thing sometimes, not a bad thing at all.
Yeah.
And I think a lot of, I don't know if your listeners, some of them I'm sure are newer investors,
Mhm.
and a lot of them are going to be locking in conventional. Conventional is not going to see the same interest rate hikes. I mean, it is going to have some, absolutely, but it doesn't follow the same rules. And so I think it still helps to like right now when I don't know what a 30-year conventional might be, 6% right now.
That's about right.
I'm not
Yep.
sure really. So 6% secondary whatever house, not your primary household. 6% lock it in for 30 years. You're still in good shape.
Mhm.
You can usually make those cash flow numbers work, and you don't have to worry about the 5-year balloon like we are. We're thinking about, okay, which properties are coming up for renewal next year.
Mhm.
Okay, so we're going to be at higher, whatever the interest rate is. So where are we at with rent? So that's where we're kind of, not only on the buy side, but also on when you get commercial loans, you got to think about which ones are coming up,
Yeah.
because some of those first year houses we bought
Yeah.
are now, we're at the 5th year next year, and we're going to be starting to see some renewals come up.
Yeah.
And that's things you have to pay attention to. And so then you have to go, okay, so where's rent? Have we been keeping up with market rent, or
Mhm.
have we not been? So let's start talking to our tenants, kind of seeing because if our cost goes way up, we can't just pass that along to them at one time.
Yeah.
Yeah.
We need to slowly increase and be fair to them.
Yeah.
Love it.
I think a healthy exercise too. So this is not on our home loans, but like on my pharmacy loan when I purchased the business. I sat down yesterday and looked at what would the payment be, or what would the amount owed on the business be at year 5 when my pharmacy payment balloons out, and what would that payment amount be at 10%. And what do I need to save up or pay extra over the next 5 years to pay it down to keep my payment the same now?
Love that.
So now I know over the next 5 years, I need to pay, maybe 15,000 extra per year on that loan to capture less than the payment I have now. So I think it's thinking ahead of time. So if you have cash flow on an $80,000 house of, I don't know, $200 a month, maybe it's beneficial to put some money down every month, a little bit extra, to pop that principal down if you're doing an in-house or commercial loan where you're getting it ballooned out. So I think it's being proactive too. So that's one approach I'm doing on my pharmacy business. Is I'm planning on paying, extra 10, 15,000 a year. So when it balloons out, my payment should be less, even if it's up to 10% interest rate.
It's a great strategy. Love it.
Yeah.
Yeah, and I think those are some really key considerations that as you get further along, because you mentioned with conventional mortgages, yeah, you don't generally have those balloons in there where 5 years in, either the whole thing's due, and so you have to refinance it, or you have to pay it off at the 5-year balloon mark. Like I think that's a scary thing for new investors, but I think a lot of new investors can generally leverage conventional mortgages through a very traditional mortgage broker or bank.
Right.
What you're doing is as you've mentioned, being past the 10 home mark, it's forced you into some of those loan products that would have the balloon. Not a bad thing. Just you need to be a little more cautious with some of those terms on those loans. Absolutely.
Yeah.
One of the other things that has shifted in the last year is price appreciation. And so I know that we've, over the last year, over the last 2 years in different parts of the country, we've seen 20% year over year increase in value. I'm wondering kind of how that looks in your market and if that's shifting strategy at all, particularly for, some of these rentals that you've had them for 5 years. Is the value changed enough? Are you thinking about selling anything, or what is all this appreciation done for your business plan?
So I'll give an example. In the last year, 2 years ago, my house that I live in was worth probably $215,000. I could sell it now for about $300,000.
Wow.
So probably a 25-30% increase over the last couple of years. The good side of that is if you want to refinance and pull cash out, it's a perfect time to do it. So prime example, I think the last time we were on your show, we were building 2 duplexes. Well, because of the supply cost, our budget, was inflated a little bit. So we were able to refinance and capture that increase in the margin to pull cash out and do that. So that was one benefit for us in that. So
Yeah, but I mean, I think, are you more asking about the market as a whole as for buying property, or uh, what are you more asking?
I guess really both. I'm curious how when it comes to buying, what the price appreciation has done for you, and even in terms of selling, what you've thought about peeling out of the portfolio. Because I know you had some examples in the last time we talked about, this house just made more sense to sell.
Right. Yeah. So we did end up selling. I guess in the last year, we did end up selling one. It was in an area that we just weren't super keen on. We had some issues selling it, but we were able to still net like 50,000 on it or something like that.
Yeah.
Nice.
Close to that. And it was, it's not an area that's just known to be like a super great area. And so it's not an area that I would say I would love for my wife to walk around when it's dark outside. And so I said, maybe that's, while we were kind of adjusting some financial things, we had some extra costs on remodeling a couple properties, so we needed the cash. So we said, let's just sell this one, pay some things off, get flush again. And so yeah, I mean, actually, the inflation helped us, or the appreciate. I think it's the appreciation on our properties. It helped us to get out of that situation. But yeah, I mean, buying right now, it's just like everybody talks about. It's just
tough.
Do you buy? I mean, people ask me. I talk to a lot of newer investors a lot, and they're like, well, "Do I buy now, or do I wait till prices come down?" And I just from what I'm paying attention to a lot of things, and I go, I don't know if the market is gonna if prices are gonna come down, just because of lack of inventory.
Yeah.
If there's still no supply, and there's still a lot of demand, because more people have gotten into the business in the last 2 years since COVID.
Yep.
More people are investors, so there's more demand, still lower supply. So that doesn't tell me that prices are just going to automatically go down just because interest rates are going up.
Yeah, I think there's a lot of people that are sitting there waiting for something bad to happen, and they might just be stuck waiting for a long time, and
Might be,
or
or they might look really smart.
Right? Who knows? It's impossible to say. That's why I love when you guys talk about just running your own numbers, running your own race, making sure it works for you, and then just proceeding anyway, and not trying to time everything out, because none of us know, right? You can't guess.
Side story on that neighborhood that he was talking about. So I own a house, or owned a duplex. We've already sold it with another realtor in town. And my buddy was painting that house, and he sent me a picture. He goes, "You'll never find this anywhere else." So we took an old refrigerator out, put it by the street, and this guy comes in, says, "Can you help me load this?" And he has a trailer on the back of a zero-turn mower. And homeless guy, somebody gave this homeless guy a zero-turn mower. So we've got a picture of him hauling off a refrigerator with a zero-turn to go get scrap money for it.
Oh, man.
Can't make it up.
Cue in any Arkansas jokes.
Yeah, cue in any. So now you see why we sold that sucker.
That's awesome. I love that. I'm just picturing this guy cruising down the road in his zero turn. Like those are nice, man. Those are good. Those are nice.
And it's a bad. Y'all have bad boy lawnmowers up there?
I've seen those. Yeah.
Okay, so that's out of Arkansas. It's an Arkansas brand, and but it's a bad boy lawnmower that he drives. It's like a $8,000 to $10,000 lawnmower.
I was gonna say those get pricey real fast. Like the floor of those is like $3,000. Nice. So that's all right. One thing you mentioned too that I want to go back to briefly, I think it's important, is that you said the rising costs of rehab, and again, all of us have dealt with supply chain issues in some capacity over the last 18 to 24 months. How has that changed your approach in rehab costs or estimating those costs? Has it had an impact there for you guys?
No, we get all our materials for free.
It's just been easy. Yeah.
No, man, it's affected us a lot. And it's hard to really pinpoint every little thing that's gone up. Mm-hmm. But every little thing has gone up, and it's gotten harder to get certain product. We've found, but it's helped us we've shifted a lot, and this is, I'm talking on the rental property, but also the construction side.
Yeah.
We've shifted a little bit on who we use for certain things, for vendors, because we've started to find, this vendor has doors that are 2 weeks out, whereas everybody else has them that are 12 weeks out.
Mm-hmm.
So we'll use him for that. we'll use this guy for the windows. We'll use these people for the lumber. So we've kind of, instead of just going into one shop, we've actually had to start piecing it together to get our full package. Anyway, so that's part of what we've had to do to shift. But yeah, I mean, it's affected, several of our properties where we run our numbers and they work. And then we get into the remodel and prices have gone up. And we go, well, shoot, what are we supposed to do? But then on the flip side, we ran on the duplexes we built, we ran our numbers, prices went way up on lumber whenever we were about to build. Well, it took us 3 months to get the earthwork done.
Oh, wow.
To get out, 50 loads of shell and letting it sit and all that took us 3 months. In those 3 months, lumber dipped a little bit. Right around the time that we were pouring our slab and ordering our framing package, and we got our lumber for like half of what at the height of where it was in COVID. So sometimes it works out that way.
Yeah.
I'll call that thank you, Lord.
Right.
Providence. Very, very grateful for that because that actually ended up. I think our overall savings on that was like $15,000.
Wow, that can make or break a deal sometimes too, man.
Yeah.
Yeah. We may have had to sell another house just to pay for it, so pay for the lumber. But anyway, so it kind of goes a little bit both ways. Right now, all I'm seeing is increases. It seems like in everything. A basic exterior door that I used to pay $250 to $300 for. I just got quoted at $750. It's like,
wow,
just a basic fiberglass single pane, or a single glass window. So it's crazy. But everybody, I was talking to a guy today, another builder, and he said, people ask, hey, what part of the supply chain in building do we need to go ahead and order ahead of time because we might get something else that they say can't get for another 4 months, So what's that next thing? And he said, throw a dart at the board. We don't know. There's just no way to know what you're going to need or what's not going to be available here in the next couple months. Yeah, definitely seen a lot of change.
Yeah, the timelines are crazy right now. And you're right that a great tip for people is to shop around. We found the same thing with windows. One vendor was 12 weeks out, the other was 2 weeks out. And so that was an obvious solution. Even though we had to pay more for the 2 weeks, we just had to do it because we couldn't let the property sit that long. How is this reflecting into maintenance costs? Because I love that you are emphasizing to work your numbers, work your equation, make sure the cash flow works. I know a big part of the cash flow equation is setting aside for maintenance and capital expenditures, those big and the small repairs that happen. So I know my experience was that I had a fridge go out last week and that fridge cost a lot more than it would have cost 3 years ago.
Yeah.
So I feel like I'm having to factor in increase in maintenance costs, increase in CapEx fees. How are you guys dealing with that with your properties that you manage?
Rent shot up a little bit though. So,
Mhm.
so let's go, 2 years ago for a 4-bedroom house, we're running comps on $1,100 a month. So now we're sitting at more like $1,500 a month.
Oh, wow.
So yeah, if we're running CapEx at 10%, so that's pretty normal with bigger pockets and everybody teaches. So if you got a $400 increase, that's $4,800 a year. That's $500, give it or take. So that eats up a lot of that. So I think it helps out. So
I think one other thing that we did though to shift specifically in maintenance costs to help in maintenance costs is we used to provide washers and dryers.
Yeah,
that was a service that we provided our tenants, and we just cut it off. We just said, "I'm sorry, but we no longer can provide that service." The washers and dryers that we had already grandfathered in, we said, "Those are yours. You can have them. That's a gift to you. But if it goes out, that's your own expense." So that because we were getting, I think. I don't know, my wife could tell you better, but probably 8 to 10 maintenance calls a month just for appliances.
Wow. Yeah.
And washers and dryers happen to be the biggest one. And so we've also, we were buying used appliances at one point and we stopped doing that. That was an experiment that failed miserably. So we started just ponying up the extra dollars to get the brand new ranges. We started using somebody local. It's a local appliance company that we use. That it's a little bit more expensive, but man, their service is better. They're better with the tenants and all that. So, we're paying a little more in maintenance. Part of it's maturity in our business. We're trying to give our tenants better product. So we're paying more, but also, like you said, the refrigerator, the $500 refrigerator doesn't exist anymore. I mean, the old over under that you could pick up at Lowe's for like $480, 500 with an ice maker, is now like 1,000 minimum. And man, it blows my mind. But I think everybody's trying to shift. I see those companies using different brands, like because they're trying to shift to make their prices stay low. So I mean, it's hard on everybody. It's not they're not the ones that are at stake. But so maintenance has been a definitely challenging for us. But we've been working on systems to make it better, not necessarily cheaper.
Yeah. We've also shifted too. So one of our close friends has got 100 doors. So, anytime you want to learn, he's been doing it for 15 years. And I would say we're doing this new approach probably on 70 to 80% of our homes. But if we go in and the AC unit is 10 years or older, crank it out, put a new one in. If the roof's old, let's put a new one on. And pretty much every house gets all new toilets, all new hot water heaters. And that if you're doing that, your CapEx cost pretty much nothing then. I mean, you can level 10%, but you don't have that much going on. And he said, if you're going to borrow it in the beginning, might as well do it. He goes, just go ahead and get it done in the front end. You don't have a whole lot less cost. So we've got.
It doesn't cost us that much over the term of the loan.
Yeah, the two houses we're remodeling now, they're going to be getting new roofs, new ACs, new hot water heaters. I mean, everything's going to be brand new. So, that takes a lot of the calls away.
And a lot easier to do it now before there's a problem, and then it's a leak, and then it's drywall repair, and 10 of it sets you up for success later. I love it.
Oh yeah, and it's finding subs that you like. So for instance, our plumber. Now our plumber, he just goes in and checks everything. We don't tell him just to go install the sink. He's checking every line, everything for us. So we might have sent him in there for a $200 item. We might get an $1,800 bill, but we trust him though. Yeah. So and we know that. If we wouldn't have done that, we're going to get a mad tenant that their sewage is backed up. And then you've got sewage backing up in the house, or you've got to replace a line in the front yard.
He's going to be the one going underneath the house.
Yeah. He'd rather fix it on the front end. So I think it all goes back to relationships. If you have the subs you can trust, let's get it all done on the front end. That way we don't have to worry about it on the back end.
Absolutely.
So, and it's a whole lot easier to put down 15% on $1,800. And borrow it from the bank, or we can pay $1,800 from cash flow, So it's a lot easier to do it that way if you're looking at the finance route.
I have a plumber just like that. He was over at my property the other day, and it was raining, and he's like, Nate, your storm drain's backing up in the driveway. You want me to snake that and scope it for you and all this stuff? And I'm like, that's the kind of guy you want to have, where you're not just sending them over and they do the job you send them for. They do the job that you need done. Like that's the guy to find. So that's awesome.
Absolutely. They care about you.
Exactly. Yeah. He takes care of me. It's good.
Yeah, no, I love the tips about just handling everything up front that makes things so predictable moving forward. We got in the same trap the other day where we put a used dishwasher in and it lasted a grand total of 3 days. Then we buy a new dishwasher. Yeah. So just handling all this stuff, doing it right the first time just simplifies everything for the predictability of the property, for the rental math, for everything.
I'll tell you one real quick to jump in with the dishwasher thing. I may have mentioned this before, but man, I've actually found I probably have between our properties 7 or 8 properties that don't even have dishwashers. Like the cabinets weren't built to hold a dishwasher, and so instead of just remaking the cabinets to fit a dishwasher, we just didn't and never put one in. Best decision we've ever made. Never have to replace a dishwasher that you don't have. And I've seriously never had a single tenant say that they wish they had a dishwasher. Never once. If they have one, they'll use it. But if they don't have one, they just stay on top of their dishes better, or they don't.
Let's be honest, though. Their search history on YouTube probably says how to wash dishes because nobody washes them at all. Guaranteed.
I love it.
One of the things is the just kind of future of interest rates? Because I know you mentioned this kind of stress testing your portfolio of what happens if we hit 10%, what happens if we hit these other things. So I guess thinking through where you guys are predicting the market to be in the next 6 to 12 months, is that doing anything else to change your strategy further? Because like you mentioned, you're doing a lot of reading, listening to people. I appreciate that you guys are really tuned into this. So as far as what your crystal ball is showing, what's coming and what are you doing about it?
In our market, so we're in the South. So, home prices here are pretty affordable. You can get a 3,000 square foot house now for $500,000 new build, somewhere in there. So, that's a lot. Back in the day, that was 350. But anyway, so Zac and I were having this discussion beforehand, and I think you're probably going to see home purchases in the next year go back to where they used to be. So on the $100,000 house that needs a fixer upper, you're probably going to see less demand on it. Number one, the people that are going in there to borrow at 10%, now their interest rates have gone up, so it's going to make their first-time home buyers' payments go up by $300-400. Well, when you're on a fixed income, $300-400 is a lot of money. On the flip side, you have these people that are new investors that might have to put some cash in. That's going to scare them away. So I think in our market, I think it's going to be easier to leverage some deals that way. And on the higher end side, if you've got a family with dual income, maybe 2 teachers, 2 nurses, whatever, you name the college degree salary. If they're making, 6 figures, $100,000, which is easy for 2 college graduates, you can usually scrounge up $500 or $600. That's not a big deal. So I think your 200,000 plus home prices in our area, which gets you a nice home, is not going to be touched as much. But we're hoping to see some more deals here. I think we probably will, because back in the day, in 2018, on a 25, 30-year home that was a fixer upper, there was the same 4 or 5 guys bidding on it. So it might be listed for $100,000. We'd go in at 90,000 cash and get it.
We knew all of our competition.
Yeah.
That's just 4 years ago.
Yeah.
And now, everybody is.
Yeah. But
every single person's an investor.
But face it, if your interest rate on a $100,000 house goes up 3%, that's $3,000 a year. So that's $300. If you're on, a very limited budget, $300, that's huge. So I don't know. I think it's going to be very interesting to see.
So guys, I love all these tips and all this stuff has been great. I'm a little nervous. We're scaring off our newbies, right? Everybody that's listening to this is like, man, these guys are so impressive. They've done all these deals, all these houses. They've been buying for years. So like taking a step back for just a hot second, like what's some advice for those new investors out there? People that are thinking about jumping in. What's a way for them to get them started with all the unpredictability that's going on in the market?
I'll say this, and this is I tell a lot of new investors is if I would have been worried about the market in 2012 when I bought my first house with my brother, if I would have been concerned about the market, if I would have been thinking about that a lot, I probably wouldn't have bought it. I honestly did not have enough knowledge to be scared of it. Probably should have been, but I wasn't scared of the market. Probably overpaid for a house. Okay, I bought that house for $80,000 in 2012. That same house is not in like the best area, so it hadn't appreciated super well. But that same house now I could easily sell for about $140. Okay, so 10 years. That's not, but $60,000. It's not super impressive compared to like California numbers. But at the same time, 10 years makes anybody look like a genius. It's just that time. If you look at just the overall market, okay, you're probably going to go up. Now, if you would have bought in 1998 to 2008, 2008 probably didn't look like a genius, whenever the prices went down. But in the grand scheme of things, usually time is going to make a bad deal an okay deal. And so if you can hold, that's if you hold. It's just like the stock market. If you buy high and then the stock market dips, you haven't lost any money.
Mm-hmm.
You only lose the money when you sell.
Love it.
And that's what I think that's what people oftentimes will do is they go, well, the market's going down. I better sell now before it gets too low. And then at that point they're selling for a loss, or they're so scared that they don't do anything about it, and so they get foreclosed on, whatever the case may be.
Yeah.
So I think too, though, one very key thing is don't be skinny on your numbers. I think this is the wrong time to try to over leverage yourself. 100% financing is not where, people say invest with no money down. Don't think that's necessarily the thing to do.
Yeah.
I think put some cash in, put some equity, have some equity. If you don't have money to play, don't play.
Yeah.
You need to have money.
Great advice.
To be able to play this game.
Yeah.
And if my wife hates this analogy, but a rising tide lifts all ships, right? But whenever the tide goes down, you see who's skinny.
Mm-hmm.
Yeah.
Like that's when you see people who haven't been paying attention and they've over leveraged themselves and they haven't been putting their life jacket on.
Yeah.
Because they didn't put any money in, they don't have any equity. They're the ones that are going to be swimming.
Yeah.
And so I think that's important to say. If you don't have the money, let's not be real estate investors.
Yeah. So speaking to the pharmacy crowd, because I'm a pharmacist by trade, we're over analyzers. We have to look at every little scenario. And so I've got a couple buddies right now that are pharmacists. One that almost got his first deal, and that was one of the things we talked about. Like, hey man, you can analyze it, but sometimes the best education is just getting your feet wet. Mm-hmm. So before you hop in, don't overanalyze it. Do your homework. But number two, for newbie pharmacists that are trying to get in, that are worried about the cost, we're lucky enough to have a salary that $5,000 to $10,000 shouldn't be that hard to save up. So $10,000, $12,000 for a down payment, it shouldn't be that hard. If it is, we need to go back to the regular Your Financial Pharmacist podcast, the Joe Baker book, and let's start from ground zero.
Exactly.
But seriously though, we're lucky enough to be able to save up money to be able to get down and do your first investment. So don't let the money scare you. Just save some money up. And then number two, just don't overanalyze. It's not a hard game. Once I'm an overanalyzer and I still get told to shut up or quit looking at stuff so much, just get my feet wet. It happens at least once a year, maybe once a month sometimes. So sometimes you just got to get your feet wet and learn. And most of the time in real estate, you might lose $5 or $10,000, but like Zac said, in the long run, you're going to make your money back.
I love it. I think those are perfect tips right now to make sure that you've got some equity, that in the case you have to sell, you have some cushion there. And I love what you've been saying the whole time about making sure that the equation works, that you have money in there, that if rents dip a little bit, if expenses go up a little bit, if your interest rate shifts because you're on an adjustable rate or whatever else, if you can absorb all of those things, being able to cash flow the property at the end of the day is what helps you to hold it really long term when you're not feeding it at the end of the month. So these are fantastic tips that I think, particularly those that are a little cautious of getting into market right now, hopefully they can take that to the bank and feel a little more comfortable.
Yeah. The one other thing I would add, it probably would raise questions because a lot of people are coming out of school with a lot of debt. But if you still got student loan debt, you shouldn't even be thinking about it. You shouldn't be thinking about it at all. Because when I got out of school, I had $100,000, which now I think is double. Like $200,000 is pretty normal. So if your minimum payment's $2,000, get that stuff knocked out. Mm-hmm. Then you've got the wiggle room in your margin. Even if it takes you 10 years and you're 32 to buy your first house, that's great. You got a long time to get it paid off. So don't get in a hurry. Get your personal debt paid off before you get jumped in, because it takes all the stress away, makes life a little easier.
Great tip.
Love it. If people want to connect with you, where can they find you and learn more about y'all?
So you can't find us at all. Yeah, we don't. I have
social media.
I have Facebook, but it's just for the pharmacy. But anyways, our pharmacy name is Smith Family Pharmacy in Conway, and they can go on there, and it's got my email. It's blake@smithfamilypharmacy.com. They can reach me there, and I'd love to connect with them.
I'm looking up my Instagram. I think I have an Instagram. No. Our Instagram is Hendricks_remodeling. And that's I guess you can look that up on Instagram.
It probably gets updated a lot, so we should head there.
It actually does.
Okay,
I have a guy that posts. You actually ought to look at it. He does a really good job. He does like these reels. They're videos, but they call them reels on Instagram. And it's like all like fast motion time lapse. There you go. Time lapse videos of our guys building cabinets.
Cool.
And doing demo and installing. So it's actually pretty cool stuff. he shows me some videos, and I'm like, how'd y'all do that? Like, I'm the most technologically stupid 30-year-old you'll ever meet. But I'm like,
You need to post pictures of the last house where we fell through. So we bought a house, the only MLS house we bought it cash for $50,000, 1,200 square foot house. So imagine how bad it is. So Zac going to look at it with me fell through twice. And then I took my father-in-law in it and fell through myself all the way to the ground. I mean, felt dirt below me.
Oh my
So
gosh.
it's a doozy.
That's a house. That house could have its own show.
Oh, it could.
You have to have it on. Like, whenever we finish that house, I'd love to give more detail of how we came out on that house, because right now it feels like we're probably going to be underwater on it.
We'll hold you to that then. We'll do a deep
several
dive.
Several people have said, I thought you were going to tear that one down. What happened?
Yikes.
Or it looks like it's already halfway torn down. Why aren't you finishing it off?
Oh man.
So
Well, good.
Historic district and zoning is the reason. It's get into more deep dive on that one someday.
Good. We'll have you back for that. And again, really, truly appreciate you guys coming on the show again. It's always inspirational to hear you guys' story. You guys have such great educational tips, and it's again, just really appreciate you coming on and sharing this story and continue to talk to our audience and to us. It's been really fun.
We appreciate it.
Yeah. Well, thank you guys for what y'all are doing.
Yeah. Thank y'all.
Absolutely.
Thanks so much, guys.
Yeah.
Thank you.
You're welcome.
Thanks for listening to the YFP Real Estate Investing Podcast. If you like what you heard on today's show, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone that would make a good guest, or want to connect with Nate or David, head on over to yfprealestate.com and join the growing YFP Real Estate Investing Facebook group. As we conclude this week's episode of the YFP Real Estate Investing Podcast, an important reminder that the content in this podcast is provided to you for your informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on this podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist, unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you for your support of the YFP Real Estate Investing Podcast. Have a great rest of your week.